Have you ever heard the term Forex trading and thought, what on earth is that? It sounds super complicated, right? Well, the truth is, it's probably simpler than you imagine. So today, we're going to slice right through all that confusing jargon. We'll get straight to the point, what it is, how it actually works, and the basic lingo you've got to know. Let's dive in. All right, let's kick things off with a quick question for you. When you think of a huge global financial market, what's the first image that comes to mind? Probably the New York Stock Exchange, with the big bell and all that, right? Or maybe the tech-heavy NASDAQ? Well, get this. What if I told you the biggest market on Earth makes those look kind of small? Yup, it is not the stock market. The single biggest financial arena in the entire world, and it's not even close, is the one where currencies themselves, like the dollar, the euro, the yen, are traded. And that is the Forex market. You might see it written as FX too. It's basically this giant worldwide hub where literally everyone, we're talking huge banks, big institutions, and even regular folks, are all speculating on how the values of different currencies are going to change. Okay, so now we have a handle on what it is, but the real question is, how does it all work? Like, how do people actually make money from all these tiny shifts in currency value? Let's break down what a basic trade actually looks like. When you boil it all down, the core idea is really simple. You're basically making a bet that the currency you buy is going to get stronger or go up in value compared to the one you sell. That's the name of the game, right there. Think of it like this. It's really just a two-step process. First, you use your money to buy a different currency. So let's say you use US dollars to buy some euros. Simple enough. Then for step two, you just wait. A little later, you exchange those euros back into dollars. And here's the magic. If the euro got stronger against the dollar while you were holding it, you end up with more money than you started with. You've made a profit. Okay, let's put some real numbers on this to make it super clear. Imagine you decide to buy 10,000 euros, and at that moment, the exchange rate is 1.18. That means your trade is going to cost you 11,800 US dollars. Now, let's fast forward a few weeks. The rate has moved up. It's now 1.25. So you sell those 10,000 euros back, and boom, you get $12,500. That's a $700 profit, all because the value between those two currencies shifted. So to actually get in there and make these trades, you've got to learn to speak the language, right? And the absolute foundation of Forex language is something called a currency pair. When you look at a Forex quote, it's always going to look something like this. You'll see two 3-letter codes with a slash between them, and then a price. I know, at first glance, it just looks like a jumble of letters and numbers, but I promise, everything you need to know for a trade is packed right into that little quote. So every single pair is made of two parts. The first currency you see, in our example that's GBP for the British pound, is called the base currency. The key thing to remember here is that the base currency is always equal to 1, just 1. The second currency, here it's USD for the US dollar, is the quote currency. And its job is simple. It tells you how much of it you need to buy 1 unit of the base. So, let's connect the dots. That whole quote we saw, all it's saying is this. 1 British pound will cost you 1.21228 US dollars. That's it. That's the exchange rate. See? Not so scary after all. Okay, so you can read a quote. Awesome. Now what? What do you actually do with that info? Well, this is where we get into the two most basic moves in all of trading, going long and going short. It all comes down to what you think is going to happen. If you decide to go long, that means you are buying the pair. You're essentially saying, I believe the base currency, in this case the pound, is going to go up in value. On the flip side, if you go short, you're selling. You're betting that the base currency is about to go down in value. Now, this can get a little mixed up in your head at first, so here's a super simple way to lock it in. Long equals buy. Just burn that into your brain. If you're going long, you're buying. And of course, the other side of the coin is just as easy. Short equals sell. If you're going short, you're selling. Long is buy, short is sell. Say it a few times, it'll stick, I promise. All right, hang in there. We are almost done with the basics. There's just one last little layer we need to peel back to really understand the prices you see. And it involves 3 little words: bid, ask, and spread. So you might have already noticed this. Whenever you look up a currency pair, you don't just see one price. You always see 2, and they're always just a little bit different from each other. Ever wonder why that is? What's up with that? Well, Those two prices are called the bid and the ask. Here's the easiest way to think about it. The bid price is the price you sell at. It's what the broker is bidding to buy from you. The ask price is the price you buy at. It's what they're asking for. And an old trading rule of thumb is you always buy high at the ask and sell low at the bid. And that tiny little difference between those two numbers, that's what's known as the spread. Honestly, the easiest way to think about it is as the broker's commission. It's how they make a little bit of money from making the trade happen for you. And the math behind it? Couldn't be easier. You just take the ask price, subtract the bid price, and whatever is left over, that's the spread. Okay, let's wrap this up with a quick review. What did we learn? 1. Forex is the biggest market on the planet. 2. You always trade currencies in pairs. 3. Long means buy. You think the first currency will go up. 4. Short means sell. You think it's going to go down. And finally, the spread is just that little gap between the buy price and the sell price. So there you have it. You now get the basic mechanics, the fundamental language of Forex. But, and this is the big one, this all leads to the most important question of all. Why do these prices move? What are the massive economic forces, the political news, the global events that make these currencies wiggle up and down every single second? That's where the real game is played, and that's the next big thing to explore.